Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike.
Mike Zlatnik, and today it is my pleasure and a privilege to welcome Matt Calhoun from the Equity Trust. Hey, Matt.
Hey, Mike. Thanks for having me.
Thanks for coming on our podcast. Yeah. Matt is the Director of Business Development at the Equity Trust, and we are going to talk about latest and greatest in the world of IRA custodians. Equity Trust, you think you're the largest IRA custodian, unless somebody else acquired other shops, got bigger than you. If I remember correctly, you are the largest of self-directed custodians. So I'll turn the floor over to you. What's new with you personally? Always, about you and the family first, and then we will move into the business. What's latest and greatest?
Yeah, things are good. Things are busy. I have 3 kids at home, so all 3 kids under the age of 6, with 6 rental properties that I self-manage, as well as full-time job here at Equity. So, definitely using my time wisely each day. So things are good there. As far as like the industry as a whole, it keeps us busy. We're growing, getting into different asset classes, and just finding ways to get word out. And a lot of times in the circles we run in, people do know about IRAs. They know you can use IRAs for alternatives. But as a general population, most people just don't know it still. And it's about getting the word out, getting on podcasts like yours, or just in general, speaking to people every day about the power of getting in alternatives with their retirement accounts. So, yeah, doing well there.
Well, that makes sense. So most of my audience has experience, knowledge, at least of the alternative custodians, yep. Self-directed custodians versus, Bank of America or JP Morgan Chase. You set up an account there, and it's self-directed. You just can buy stocks and bonds yourself, right? That's about it. Mutual funds. With alternative custodians or self-directed custodians, folks can do pretty much anything. Well, I'll turn the floor over to you. I guess it's not pretty much anything. There's still limitations. But just give us a quick overview. And then you also mentioned that I guess you're adding some more asset classes. What's new? What did you add in the last, year? Has anything changed? Has anything gotten, before it was a hot topic allowing people to buy crypto. And some custodians got in and then they pulled out. And I've seen that rodeo before. And I don't know what other asset classes. Precious metals have been around for a long time. Real estate has been around a long time, both equity and debt, private funds. Anything new? Like, have you added any other new asset classes that folks can actually invest into that they couldn't before?
So it won't surprise you. So we're subject to whatever the U.S. government allows retirement accounts, and they really have never updated anything. Crypto is never mentioned. So most of this just involves around investors get, curious. They want to chase bigger returns. They want new asset classes, and the custodian has to find ways to evolve and allow that. We don't get government guidance in most cases. We adapt to some litigation here and there, but for the most part, we're up to our own devices. So you're right. Cryptocurrency is still kind of the big one. I'd say most custodians now have found ways to hold crypto. And you're right, a couple of years ago, they'd find small ways, they'd outsource it. Equity is one who definitely has taken a big stand into getting into the crypto space, whether you're supporting back offices for people who are doing their own, or just kind of offering it through third-party providers. So yeah, crypto is definitely, I think, grabbed on. There's no guidance. There's nothing that said, yes, this is definitely a liable class. What's really directly said by the U.S. government is you can't hold life insurance, you can't hold collectibles, and then you're kind of left to figure it all out from there. We kind of treat crypto in similar ways to precious metals. As you mentioned, precious metals being probably a top 2 or 3 asset class in retirement accounts in our space. We kind of treat it the same, try not to have personal possession, have a third party involved, things like that. But essentially we're guessing at that point. We're just making sure we can, hold it in the retirement account and not get the account holder in any trouble with the government there. As far as new asset classes, people are just getting into new asset classes, or they're moving out of things they were doing and getting into debt, getting into real estate, private stocks. And we see some startups here and there, but those kind of go in waves. Right now, I feel like we're riding a debt wave where people are getting into debt funds and debt investments. But real estate's always a solid investment for us. It's always holding its percentage of what our investors are doing. And then precious metals is always kind of like a good third spot as well.
Yeah, I appreciate the overview. From what I heard, at least this is very consistent with what's been going on in the industry in general. Many investors have been somewhat hurt in the last few years with the equities in real estate having adjusted, commercial real estate especially, with higher for longer interest rates. And then the banks have tightened up. So the private credit, essentially what you just said, debt funds have been a way to replace where the banks stepped out. And a lot of capital from self-directed IRA has flown into these lending funds simply because equity felt like it was a lot of people got burned and hurt. So the safer path is, of course, debt funds that loan in first position. So it's a natural kind of a flight to safety per se, and it sounds like that's exactly what you've seen. Although now this is interesting. I would love to hear your perspective. I don't know if you're beginning to see this a little bit more loosening up. In other words, investors realizing that many valuations have reset. Whether what people want to call something else, but it's been a reset. So now real estate, in my book, in my understanding, is already very attractive on a relative basis. If you buy right, if you get a deeply discounted, motivated seller, you can get into a deal at a great basis. You could make way better upside than just being purely a lender. Have you seen any initial shifts? Because it takes time. All this stuff takes time. Have you seen a little bit more interest into these deeply, and I know you guys don't evaluate opportunities, so you can't tell if it's a good deal or a bad deal. You just know what percentage went into debt fund, what percentage went into sort of an equity deal. So, but I'd love to hear your perspective, at least seeing, any light in the tunnel yet.
Yeah, and you're right. We don't basically predict things or look there, but we do see trends. It's easy to see when people keep calling you every day. You say, well, I've had a lot of those phone calls lately, and we kind of see when they invest in. 2024 for commercial real estate, no surprise, was down for us. Like not as many people were getting into those deals. I'd say Q4 and early in Q1, like I said, we've seen the debt increase quite a bit. I do see where we're starting to come back on commercial real estate. It does seem like a different conversation of going to quality, but it seems like people are going to quality providers now. You know how real estate is. I'm a real estate investor myself. Once you're in the asset class, it's hard to get out. You want to be back in. So if people are on the sidelines right now, they've been waiting for a year to get into another real estate investment. They're looking right now to get into more. So I think the buying opportunities, they're there, and people are flocking to good, solid providers that they know they can invest their money into. So yeah, I do think for 2025, we should see a good comeback in that space for IRAs as well.
Yeah, gotcha. And of course, recency bias, right? You mentioned precious metals. The precious metals have done really well. It's one of those things where when something has done well and hot, people continue to pile up. And of course, the future is unknown. Gold has been, a great bull run. But we've had, interestingly enough, we just did a presentation on relative value, and we can be subjective. You have to be, I guess, agnostic of the assets. You can't really pick and choose. It's not your decision. It has nothing to do with you. We can talk about opportunities, and I'm just going to mention this for no other reason. I saw Goldman Sachs predicting gold going to 3,100, but we are almost 3,000. So it's a little bit of move by the end of the year. So it's kind of like there's still room to run up, but the great bull run of 24 in precious metals is probably, it's very hard to replicate, let me put it this way. Sure. So just curious at which point people will start adjusting again. And then back to sort of what is Equity Trust doing to educate investors? Do you continue to bring on operators, sponsors? Do you run your webinars about different strategies? Some stuff is consistent and easy to talk to. Precious metals is a great story, of course. Talking about 24 bull run, easy. Are you doing anything to basically bring diversity or breadth of opportunities to investors? And how do investors choose? At least in your observation, have you seen any interesting trends? I'm just picking your brain.
Yeah, no, of course. So equity as a whole is pretty large. So I work in one division of equity, which is kind of the institutional side. We do a little bit more, I'd say, grassroots education side. We'll go to smaller events, larger events, and speak to people directly. We'll do some webinars. We'll bring some operators on occasion just to talk about some topics. But a lot of what we're doing is educating small groups. Most of those investors are referred to us through deal sponsors. But equity as a whole has like an IRA University, programs, courses you can buy that talk about financial literacy and ways to get in. We have a team that travels around at least 3 times a week and does workshops through the Money Is program, different things. So yeah, it's kind of all hands on deck, get out there and get the word out to get the industry going. It's just good for the industry as a whole. Like I said, depending on how you measure it, equity is one of the largest self-directed IRA custodians. And a lot of time that's all boats, go with the tide kind of thing. We get that education out and it's going to boost self-directed IRAs across the country. So all that's, just educating everything. But yes, on the website, there's ways to see interviews with different experts, as well as stuff our team puts together, just try and talk through account types, asset classes you can invest in, Roth conversions, just different things that kind of apply to all retirement accounts, but some of it's specific to alternative investments with it.
That makes a lot of sense. And today, I would think there has to be a lot of talk. Again, we're recording this in early to sort of mid-March. Well, it's mid-March, and the market is stock market has shown significant volatility. You should be ringing a lot of bells and saying, wait a minute,
Yeah.
Main Street, Wall Street, going from a Wall Street, maybe the time to get into the Main Street and take control over your self-directed IRA, and you have a lot of more options when the capital is with a custodian like Equity Trust. And back to the real estate again, this story of stock market P's on the S&P 500 being over 30, and the market could be significantly, up for a significant correction. And most folks have been too complacent. It's time to wake them up and put them back into consideration of custodians and back to real estate, right?
Yeah, for the last 2 years, we have seen increases in alternatives, but it always kind of makes me wonder why, because for the most part, you could have parked your money in the S&P 500 and made 20% each year. Those days are probably gone, at least as we're saying right now, like I said, in March. It's been a rough couple of weeks in the market. And I think people are still kind of licking their wounds, but now it's time for them to find out, how am I going to diversify? How am I actually going to get better rates of return? The days maybe of just setting it in the market and everything goes up might be over for a while.
Yeah, that makes sense. What other, innovations? Anything new from the product perspective? Because most of the, traditional IRA, Roth IRA, obviously a bunch of self-directed SEP plans, solo Ks. Um, are you doing anything new like group 401ks? I'm just kind of thinking outside of the box. Checkbook IRAs, they've been around for a long time. I'm just curious, what's been bread and butter and what's new, what people have been doing lately that you allow them to do, obviously.
Yeah, of course. On the macro side, I think the industry is starting to catch up with some technology. It was an industry that was slow moving for a long time, passing paper forms back and forth. So I think most custodians are adapting to DocuSign and getting portals created.
So electronic submissions of the bidirectional letters and all that stuff.
Yeah, which isn't groundbreaking stuff by all means.
Been around for a couple of years now, it feels like.
Yeah, it was just a slow adaptation for that industry. But I think most custodians that you work with are going to have that at this point. That was kind of like the top end had it for a while. I think everyone kind of has that now. Luckily, not too much on the regulatory side has changed things. We did have coming down the pipeline, they did pass where you could do a Roth SEP. I haven't seen custodians that have actually brought that to the marketplace yet, but it has been passed by Congress where you can actually make Roth SEP contributions. Before, those were always pre-tax. And I, hit up our product team quite often about just, hey, when can we get that? When can we get that? Just because it's a big deal for people who are self-employed. Being able to put a larger sum of money into a Roth bucket would be a big deal. We have the Roth 401k and that's not changing, but it just gives an extra option for people. Smaller to equity, what's different? The institutional division, like I said, that I'm working for, we kind of specify in one private equity, private debt by sponsors. But we've always had a 1031 arm, but we're kind of putting that to the forefront now. That was always something we did kind of locally to our offices. We're kind of taking that
How's
nationwide.
1031 relevant to self-directed accounts? They generally don't get taxed in theory, right? So why is 1031?
Yeah, correct. Some of the business systems are the same, but yeah, we rarely ever do a 1031 for an IRA. So it's kind of just an extra business option or
Why would anyone want to do a 1031 IRA? Why can't they sell an asset and then just use the money to buy an asset
yeah,
instead of exchanging it?
yeah, as I said, it's pretty rare. We'll do a few a year, but if a IRA obtains leverage to purchase a rental property, is the easy example, a UBIT UDFI tax can apply. You can actually 1031 that. So instead of having that tax, you can actually defer the UBIT UDFI tax on a rental property. So it doesn't always happen, but if your IRA did take out a non-recourse loan to purchase rental properties, a 1031 could be an example. 98% of our exchanges we do are outside of retirement accounts.
Well, on that front, and I don't know if you have this data, but I'm just curious.
Yeah.
Um, so, spoken with a lot of self-directed IRA investors who invested into some equity or own, a rental with
Mhm.
an IRA without a clue that there is UBIT, UDFI that applies in theory,
Yeah.
right? And then they sell exit, and a lot of people don't do anything. They don't file, right? And I'm just curious, have you seen a lot of people filing? So where theoretically it's due, practically you don't tell them to file, not your business, right? I'm just curious, but if there's a filing, right, the CPA has to file and you have to make a payment. So are you observing that's happening? People actually sell a rental property with a mortgage, and then they wind up actually filing. I'm just curious, just are you seeing this in any kind of meaningful volume?
Yeah, so we've put systems in place to kind of check that. If we know there's a mortgage on the property, we'll update them. Hey, make sure all of our clients who have mortgages on their rental properties, we tell them they have to have a filing. And we do a service. We'll create so you have to have a separate EIN number for the IRA because it has to do a 990T filing. We can even outsource the 990T filing. So we have systems in place that will remind them that it's due, as well as if they want to use our outsourced accounting team to do that, they can do that. File the EIN number, file a 990T. Um, the complication becomes if your custodian just didn't know it existed and you're kind of on your own. We mentioned the checkbook. That would be an option where the custodian may not even know what's going on with the rental property. And then as far as like sponsor-led ones, a lot of times we don't get the K1s or we're not checking every single K1 to see when UBIT would apply, anything like that. So that would be subject to the investor to check on their own. Um, if we're known ahead of time, so if a sponsor says yes, my deal is going to generate some UBIT, we'll alert the investor like, hey, it's filing time. You should check your K1 just to see if you need to file the 990. So we do our best. At the end, it is the responsibility of the investor to see. There's probably times where, like you said, they've done it and no one's caught it or anything else. There really would just be if they get audited, it may be noticed then.
Yeah, so actually, glad to hear that you have systems and processes in place to inform investors that UBIT might be applicable and they should consider.
Mhm.
I just seen many custodians don't even do that,
Yeah,
and then it's and how many IRA accounts get audited? Very, very few.
sure.
So if anything changed lately, I'd love to hear that. But most of the times, you just don't see custodians being audited unless something really huge. There's a big problem with the borrower or with the owner, not the borrower, with the owner.
Hmm.
So they go through massive personal audit and then they start auditing IRA accounts. But beyond that, it's just kind of a sleeping, quiet type of But let's move on. It's just kind of my
Yeah,
observation.
yeah,
The
yeah.
fact that you have system and processes to help investors make the determination. That's great. What else? What else is interesting new, sort of from opportunities
Yeah.
perspective? And also, you mentioned institutional division versus is that another retail division? What? Just curious.
Yeah. So there's a retail division, and then what we would consider even like larger enterprise opportunities, where those would be like large crowdfunding platforms, APIs. So we kind of break it into three different divisions, and that's really just make sure the right service representatives get in charge, and we're able to put the right technologies in place, like a full API integration or platform creation is different. We don't handle it on our side, but there is a division that will handle those opportunities. And we just provide the best tools we can to sponsors, whether that's marketing materials, webinars, different things there. We do custom applications. So if we are setting a real estate fund, we'll embed the fund documents into our application. That way, the investor can only do one application. They don't have to bounce back and fill out subdocs here, authorizations here, transfer forms. They just can do it all at one time. And that just makes a better investor experience along. And the retail is able to have those conversations about getting leverage on your rental property or buying gold or crypto on there. So it just helps tailor the client experience a little bit more. And then as the industry as a whole, yeah, there's been some consolidation definitely in the real estate space or in the self-directed space. I think some companies, some of it's just been ownership has reached an age where they want to retire, and some buyouts have been the way to go. My company was bought out a couple of years ago too, so we were Midland Trust, and then Equity bought us and made us the institutional division. I think almost 2.5 years ago now. So that's definitely taken place. So some people who would have signed up with a custodian may have a different custodian now by choice or not. So that's definitely been an update in the industry the last few years.
Yeah, I've seen this, and I'll add one comment. I'm not trying to bash any custodians. We've seen these acquisitions and migrations have been very, very difficult, especially asset titling and number
Hmm.
of other services. One company buys another. In theory, it's all nice and easy. In practice, it's very painful, and people wind up actually, considering moving on to another
Hmm.
custodian because
Sure.
the new custodian is a very different experience from the previous custodian. In some cases, it's positive. In some cases, it is a rocky road, and fees
Hmm.
change, service level changes. They used to, something, the relationship manager changes, etc. And do
Yeah.
you have that VIP service for folks who need strong relationship managers as part of the service?
Yeah, so we've kept back in the days of Midland, that was kind of our big thing was we wanted one service rep for the client. That way they have one point of contact, and we've kept that going. So one point of contact, there's no 800 number that you have to call, and you might get a different person. And it creates a consistent experience, but also that person actually knows what you've invested in and knows you. The downside, the worst client experience is when you call in, they just have no idea what you're doing and end up passing you around to someone else. So keeping that direct point of contact has always been important, and we still continue to do that.
Yeah, I got you. I'm just curious, again, not familiar enough with the equity trust. So just going back to some situations where people want
Yeah.
to mix up alternatives and traditionals. So
Mhm.
traditionals in the past, they just keep with the traditional custodian, and then you go into self-directed, into alternatives, and
Yeah.
it would be company like Equity Trust. Do you have a link? In other words, people can open one account and then they want to trade stocks, or this point of time where they feel like they've done well in stocks, they got to get out quickly and then move into alternatives. You have a plug
Yeah.
and play other than, okay, just go sell your stocks, get cash, let's do a transfer, and then until that happens. Um, so do you have that option? I'm just curious. Does it exist?
Yeah, we do have that option. I mean, I will say people can still keep those old IRAs and move between their Schwab account. They really like it. But we have two different options. We actually have a sister company with equity brokerage that can hold it directly in-house. And then we also outsource it to groups like TradeStation or other ones. So they can do both. They have the equities options through a couple different places. That way it can all be held in one account. It's referred to as Universal IRA on our website, just a nice marketing term, but basically saying you can hold public securities with your private all under one account. Some people don't really like the idea of consolidating it down to one account, so they don't have statements from a bunch of different custodians, RMD totals from our different custodians. So yeah, we have those options in place to hold it all under one account.
Yeah, gotcha. That makes a lot of sense. It's actually universal. That's the term. It's a good term for a broad IRA that gives you multiple options.
Yep.
Um, Any other comments? Any good book you want to share? Any kind of new just any wisdom and how would folks reach out to you to want to learn more about equity trust, about the offerings, maybe Universal IRA, right? Just what's the
Yeah.
best way to reach out?
Yeah. For me directly, I don't know if we have show notes or anything. I can put my contact info on there. Can walk people through different questions they have. Um, our website, we still have the Midland Trust website that's active, but Trust ETC is the general website as well. If you reach out directly,
Trustetcetera.com, right? Trustetcetera.com.
yep. And I'll provide a contact to my calendar as well if you want to book some time to talk.
Yeah, perfect. And any again, final recommendations, books. What's a good book? Anything that comes to mind that you particularly like, or you read recently, and kind of makes you think, or you know,
Uh,
food for thought, generates food for thought. How about that?
yeah, I was just talking to a colleague recently. Everyone always talks about Robert Kiyosaki for Rich Dad Poor Dad, and I always tell them you can skip Rich Dad Poor Dad, go straight to Cash Flow Quadrant. So I'll plug Cash Flow Quadrant, an old book, but I read it again for the second or third time in a while. I think that's really the bigger game changer book that Robert Kiyosaki wrote.
Yeah, that makes a lot of sense. And it's even more relevant today. It's all about cash flow. I mean, I have to say that recent experience. I just came from a conference, and I know we just kind of get a little off the tangent, but I'll just add a couple of comments. And I talked to a lot of professional operators, and many of them kind of gravitating to building ground up and deals without the cash flow. And I
Mm,
talked to them, and my kind of position is similar to what the industry has shifted, more income focus. Why income focus? Because you have that predictability, that cash flow. The cash flow is sort of the foundation of long-term, I guess, retirement goal. You need cash flowing investments, and on the other side, all these growth projects, they depend on the successful exit. And the successful exit, you don't know what it's going to look like. There's more speculation and uncertainty related to the ground up, and a lot of folks are doing ground ups because it's fairly easy to sort of build from scratch. You don't have existing property complexities. You don't have the management issues. Some ways it's easier, in some ways it's harder. But at least you can get a deep discount on new construction, and the cash flow doesn't start until the back end. So again, cash flow quadrants are important. And I know Robert Kiyosaki talks about what the owner versus investor versus
sure.
I guess running your own self-employment. And what's the fourth one? I'm just trying to remember.
Yeah. So as employee, uh,
Yeah,
in,
employee,
investor,
self-directed,
owner.
owner, and passive investor. Right, you basically own a piece of the business.
Mm,
So folks always should think about it. They all generate in theory cash flow, just a different type of cash flow. So
yeah.
for self-directed IRAs, by definition, right, you've graduated to that fourth quadrant. I'm not sure how Robert Kawasaki calls it, but it's the quadrant when you are, hopefully part owner, where you are getting passive cash flow.
Yeah.
So, all right. Thank you kindly for your wisdom. Thank you for sharing. Sorry, I added that last comment. It's kind of fresh in my mind coming from a conference, but it's
Yeah,
relevant.
of course. Yeah.
And I'll add one more point, that looking into more investing, and you as a custodian, you don't pay attention to this, but as a fund manager, as an investor, I do. A few years ago, when the interest rates were super low, you could buy a positive spread in between the capitalization rate and the interest
Mm,
rate. Again, we're going back a number of years ago of low interest rates. So you can have a positive spread. Then the interest rate spiked. So it became very hard to create a positive spread because the cap rates went higher, but not as high as the interest rate. So it became a negative spread. Negative spread still exists today on many assets, although valuations have softened up, but not enough. But the holy grail is still to find the deal. This is how you know you got a great deal, is when you have a positive spread between the cap rate and then the interest rate. If you can do that and you can invest, it generates positive cash flow.
mm,
And of course, in this environment, we're still a great time to be a lender. This is exactly what you mentioned at the beginning of the podcast, simply because high interest rate environment high yields and loans, everybody wants to be a lender. So kind of
Yep.
market takes care of the business by itself. High interest rates, people shift their money into lending. Interest rates come down, people start thinking more about the equity.
Yep, exactly.
1 million feet, 40,000 feet view, but let's call it a million feet view. So
Yeah, nope, spot on.
all right, thank you, Matt. Appreciate you coming on a podcast.
Thanks, Mike.
And thanks for sharing. And enjoy the book, The Four Quadrants by Cash Flow Quadrants from Robert Kiyosaki. Until the next time.
Thanks, Mike.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.